Much of what I review on this channel are products from what the financial industry calls neobanks. These are fintech companies utilizing the banking services of small banks to offer highly attractive incentives. And wow, have neobanks boosted competition within finance, making big banks completely overhaul their interest and overdraft policies among other services, just to retain their customers. Now, unlike big banks with their credit cards, neobanks can't gather interest from debit cards because debit cards aren't based on debt, making their primary way of earning revenue the interchange fees paid by merchants on each swipe of a card. These are very small, like we're talking cents per transaction. But some of the incentives are pretty massive when it comes to these neobanks, such as Current's 4% APY high yield savings account, or Point Card's 1% cash back on all purchases. So the question is, how will all of this affect yours and my money? And how will banking evolve with the wave of these small banks popping up right and left? We're getting into that right now. In short, it appears that the evolution of fintech is going to be great for everyday people like you and me. However, neobanks have a long way to go when it comes to a sustainable model. In fact, within a 15-day span of time, I got emails from 2 different neobanks that I've reviewed announcing the sunset of their debit cards. RIP the Point Card Neon and the Cheese Card. May you live on in the memories of this channel. Now, some of what I'm about to say is speculation, just to be clear. I don't know any of the real reasons these fintech companies are shutting down these services, but I can only imagine that it has to do with cash flow. If you look at Discover's cashback debit card, personally I think that it serves as a sales funnel for their other products, namely credit cards, because that's where Discover is going to make the majority of their money charging interest on credit card balances. So despite their 1% cash back, they don't charge any monthly fees, likely because they want you to sign up for the credit card next. Their debit card is a gateway drug. Cheese Card was also totally free. No monthly fees or anything, and they provided cash back on purchases from specific companies, as well as monthly deposit bonuses. But they really didn't have any other products to funnel their customers to, so maybe that was part of its downfall. Point Card Neon was not free, morphing its pay structure on multiple occasions through its groundbreaking time in fintech. It went from $50 per year to $100 per year to $120 per year, probably to help subsidize their 1% cash back on all purchases. But then this, no more Point Card Neon. Now Point still has another product that they're launching called Point Card Titan. It's a charge card, so almost a combination between a credit card and a debit card, and it'll have a $400 annual fee for admittedly pretty good benefits. And for all I know, maybe this was the goal from the start and Neon was just a way to get into the market. Regardless, I suspect neither bank would disagree that it's difficult to make a profit on a debit card, especially one with excellent benefits. A real bummer too, because this was my favorite debit card. The question is, where are we going with fintech and especially these neobanks? Bloomberg posted an article last month about the challenges that neobanks are having in fulfilling their promises, outlining the basis on which neobanks are started and kind of how many of them operate. The article says, the thinking is that if you capture enough millions of these small customers, then eventually some of them will become valuable customers and you can mine their data and cross-sell them other products. For the time though, the number of neobanks offering services to customers is changing the industry and changing it very quickly, because big banks have notoriously offered very mediocre benefits to their customers, offering maybe 1 or 0.02% of interest on savings accounts. It looks like that's starting to change though. For instance, in the same article it says, JP Morgan Chase & Company CEO Jamie Dimon, in a call with analysts in October, said he will spend whatever to keep pace with fintech competitors. This is great news for consumers, because despite the closure of neobanks, or at least the products that they offer, this can only mean better benefits for consumers overall, because big banks are going to be changing their products and services just to retain their current customers. It's the beauty of capitalism. Companies have to shift in order to keep people's interest and business. Now, despite the challenges that neobanks are having in delivering on their promises, I don't think this segment of fintech is going to slow down anytime soon, because according to Fintech Today, a newsletter that I get 3 times a week, debit card usage is booming. It makes an interesting connection between debit card usage and the shift in generations. Millennials, many of whom were in college at the time, were jaded by credit after the 2008 financial crisis, turned to debit cards instead of credit. And that's where neobanks come in. A lot of these factors attributed to the rise and growth of neobanks, who have primarily offered debit cards over the last few years. Something that this article notes is that the value of debit transactions actually surpassed that of credit transactions back in 2020. The article continues to break down other aspects of neobanks having an advantage over big banks, like that they can gather a larger chunk from each transaction fee over large banks due to finance legislation. And between neobanks, new uses of debit transactions to fund fintech wallets and products, and mobile wallets becoming more prevalent, The US consumer is more debit heavy than ever. From a financial behavior perspective, I think this is healthier. Debit doesn't put people into debt and helps you control spending within your means. So neobanks, though some may have difficulty maintaining their services and products over the long term, are drastically changing finance and the tools with which you and I manage our money. I think this is great, and I don't think it's going to change the trajectory of finance anytime soon. I think you and I are winners regardless of the companies that rise and fall, because even big banks are making their incentives better to keep our business. Needless to say, I'm going to keep reviewing neobanks and just accounts that I think are going to benefit you. So if you see one that you'd like to see a review on, then drop it in a comment down below. And let me know who you currently bank with. Do you bank with big banks? Do you bank with neobanks? Do you bank with credit unions? Or do you throw your money under a mattress? That was actually a poll that I just threw up on my channel recently, and a couple people actually said that they did put their money under a mattress. Until next time, check out this video next if you want to look at the best debit cards of 2022, despite the fact that 2 of them are no longer able to be used anymore. And hit that subscribe button to keep up with fintech from the leading chocolate milk loving finance channel on YouTube.